Central banks are among the most powerful financial institutions in the world. They play a crucial role in shaping the economy and directly influence how much money costs to borrow, how much your savings earn, and even the prices you pay for goods and services. Understanding how central banks work helps you make smarter financial decisions in your daily life. A central bank is the primary financial institution responsible for managing a country's money supply, interest rates, and overall monetary policy. Unlike commercial banks where you deposit money or get loans, central banks work behind the scenes. They regulate the entire banking system, control how much money circulates in the economy, and ensure financial stability across the nation. Central banks have three main responsibilities. First, they issue currency, controlling the printing and distribution of national money. Second, they set interest rates, adjusting them to manage economic growth and keep inflation under control. Third, they regulate banks, supervising financial institutions to ensure the banking system remains stable and safe for everyone. Different countries have their own central banks with unique names. The United States has the Federal Reserve, commonly called the Fed, which controls U.S. monetary policy. The European Central Bank manages the euro currency for 19 European countries. The Bank of England is one of the world's oldest central banks, while the Reserve Bank of India regulates the Indian rupee and the entire banking system in India. Monetary policy is the set of actions taken by a central bank to control the money supply and interest rates in order to achieve economic goals. These goals typically include maintaining stable prices, keeping unemployment low, and promoting sustainable economic growth. Central banks use monetary policy as their primary tool to influence the overall health of the economy. There are two main types of monetary policy. Expansionary policy stimulates economic growth by increasing the money supply. This involves lowering interest rates to make borrowing cheaper, which encourages businesses and consumers to spend more. Contractionary policy does the opposite. It slows down the economy to control inflation by raising interest rates, making borrowing more expensive, which reduces spending and cools down an overheating economy. Central banks use three primary tools to implement monetary policy. Interest rate adjustments change the cost of borrowing money to influence spending and investment throughout the economy. Reserve requirements set the minimum amount of cash that banks must hold, which controls how much money they can lend out. Open market operations involve buying or selling government bonds to directly manage the money supply circulating in the financial system. Interest rate changes have a direct impact on your personal finances. When central banks lower interest rates, loans become cheaper, encouraging more borrowing and higher spending on things like homes and cars. Conversely, when rates go up, loans become more expensive, discouraging borrowing and reducing overall spending. These rate changes affect everything from mortgage payments and credit card interest to the returns you earn on your savings accounts. Central bank decisions ripple throughout the entire economy in multiple ways. They affect employment, as lower rates encourage business expansion and job creation. They control inflation, adjusting rates to keep prices stable and protect your purchasing power. They influence investment decisions in stock markets and real estate. And they impact currency value, where higher rates can strengthen a country's currency, affecting exports, imports, and international trade. Let's recap the essential points. Central banks control money supply and interest rates to stabilize the economy. Monetary policy directly affects your loans, savings, and purchasing power every single day. Interest rate changes influence employment levels, inflation rates, and overall economic growth. Understanding central bank decisions helps you make better financial choices for yourself and your family. Central banks truly shape the economic environment we all live in.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.